As a dividend investor, one of the key questions that you have to constantly ask yourself is when is the right time to buy a particular dividend stock? There are many ways to go about this process, but valuing stocks is a proven strategy that has worked over the long term. In this video, I want to share with you how it is that you can value dividend stocks using the adjusted dividend discount model. And just for some background, my name is Guillermo and I used to be a financial analyst at one of Canada's largest real estate investment trusts, but most importantly, I manage a portfolio of my own, and I'm the founder of a company called White Sheets, which is completely dedicated to helping people like you make better stock investment decisions. That being said, let's get into Excel and show you exactly how this dividend valuation model works. Okay, so as you can see, this is the way that you perform your adjusted dividend discount model, and this is very similar to the regular dividend discount model, except there's one key difference, and that is the fact that instead of using the regular dividend amount, you use the adjusted dividend amount. So let me explain to you what that means. In this case, what I have is this template right here, which I have set up so that way I can enter any company ticker that I want, in this case Coca-Cola, and you get the entire dividend payment history of the company, and then we're gonna also be able to automatically get the adjusted dividend discount amount. In other words, what the company is really worth based on this valuation model. And you can see right here, first we have the dividend and the adjusted dividend. So right now, what you can see is that these two amounts are the same, but sometimes they're different. And the reason why is because a company may issue or get rid of shares, which means the dividend per share decreases or increases. And so the adjusted dividend is really the amount that you should use in most cases, because this takes that into consideration. If there were more shares issued and you're still getting the same dividend payment, that means that the dividend per share essentially decreased, and it's something that you have to take into account when you do these calculations. So that is really the key difference. But you can see, in order for us to find the value of this dividend stock, the formula that we're using is this. So the price of the stock is equal to the dividend per share of the company divided by the expected return that you're looking to get minus the expected growth that you expect for the company. So let's modify this model that we have right here to suit the adjusted dividend discount model. So here we have the ticker, this is the name, so this is all good. Now here's where it gets interesting, the discount rate. The discount rate is essentially the R part of the calculation. So the discount rate is essentially what kind of rate of return do we want to get on our investment. Right now we have this set to 5%, but this changes up and down based on the actual interest rates that are happening right now. And so interest rates are high right now, so maybe we will want to change it to 7%. Now the other aspect is the growth part, which you can see right here. For the growth, this is the expected growth that you expect in the dividend payments that the company does. For that, you can go based on historical data, so you can see how I'm performing the growth rate over time. But in this case for Coca-Cola, it seems like there's pretty much no growth in terms of the dividend payments. Like here we see a decrease and an increase. So you know what, maybe what we could do is say we expect 1% or 2% growth in terms of the dividend per share payments. So that is the amount that we select. I mean, you can always change it to whatever you want, but we're just making up the numbers right now a little bit. Here, this is where it gets interesting. This is where we get the current dividend per share payment that the company is making. So you can see I'm using White Sheets to automatically get this amount as well. The key difference is that we don't want to get dividend because this is going to give us this amount right here, multiplied by 4 because there's 4 quarters in a year. By quarters, it means every 3 months. Usually that's when a company pays dividends. So if you multiply by 4, you basically get the dividend payment amount for the whole year, which is what you should use for this calculation. But anyways, not to get carried away, what we want to do is change this to adjusted dividend. So that way we don't get the value here, but we get the value right here. Okay, so now we have the current dividend. This is the projected dividend. So this is basically saying in 5 years, we expect the growth rate of the dividend payments to be 2% per year. What is that going to look like in 5 years? And this is the amount right here. So the terminal value or the price per share that we should pay for Coca-Cola in this case based on these assumptions. You can see I'm just applying the formula that you can see right here is $44 per share. So this is the amount that we should pay. Now, of course, this is just one valuation method. Coca-Cola price is probably much higher. In fact, we can go ahead and check it right now. So I'm going to do Wise price, select Coke, and then price. This is gonna load, and there you go. The price of Coca-Cola right now is $639 per share, so it makes no sense according to this valuation model to invest in Coca-Cola. However, like I said, this is just one method of valuing stocks, and for other more traditional dividend stocks, this method can be really powerful. So that's basically how you use it, so that way you can find those great investment opportunities. Now you have another tool in your tool belt, and you now know how to value stocks using the adjusted dividend discount model. So be sure to use this information, put it to action so that you can find some valuable dividend stocks that you can invest in and allow you to grow your wealth over time. And if you've enjoyed this video, we would really appreciate if you could subscribe to the channel, turn on the notifications on, so that way you get notified every time we release a new video like this that's gonna allow you to take your investing game to the next level.